On February 12, 1873, a single law erased silver's place in American money overnight, crushing farmers, miners, and anyone holding the metal as its price plummeted. Later, two billionaire brothers tried to fight back only to be crushed by rule changes engineered by Wall Street banks. Today, evidence shows manipulation at the highest levels, but something unprecedented is starting to break the cycle. The real story of silver's rigged history and why the system is faltering starts now. Congress passed the Coinage Act on February 12, 1873, rewriting the legal definition of American money. The law ended the right of anyone holding silver bullion to have it coined into standard silver dollars, a practice that had anchored silver's value since the founding of the Republic. From that point forward, only gold could be freely minted for circulation. Silver, once a pillar of the nation's currency, was reduced to subsidiary coins and a new trade dollar, good mainly for export and not for use at home. For Western miners and indebted farmers, the consequences were severe. Silver's monetary demand vanished almost overnight. As the years passed, silver's price, once fixed near $1.30 an ounce by law, began a slow slide. By the late 1870s, as European nations also abandoned silver, the market price drifted downward, leaving those who depended on it facing mounting losses and rising debts. The impact was not an immediate collapse, but a grinding, relentless erosion of value that made every dollar owed harder to repay. The law's passage was not widely debated on the floor of Congress. Many legislators later claimed they had not realized it would demonetize silver at all. But as the implications became clear, outrage spread across the West and Midwest. Congressman Richard Bland declared the act a fraud, and angry farmers and miners branded it the crime of 1873. They saw the measure as a quiet victory for Eastern bankers and bondholders, those who benefited from a harder, scarcer currency. In the decades that followed, the Coinage Act became a rallying cry for anyone who believed the rules of money could be changed to serve powerful interests at the expense of ordinary Americans. By the late 1970s, two Texas oil billionaires, Nelson Bunker Hunt and William Herbert Hunt, set out to buy as much silver as they could get their hands on. Over months, they and their partners amassed an astonishing 200 million ounces, nearly a third of the world's deliverable supply. As their buying intensified, silver climbed from $6 to $49.45 per ounce, reaching an all-time high on January 18, 1980. The surge sent shockwaves through Wall Street and threatened to topple major banks holding massive short positions. But the rules of the game did not remain fixed. On January 7, 1980, the Commodity Exchange in New York, known as COMEX, invoked emergency powers to restrict new long positions in silver. By January 21st, they went further. Silver trading became liquidation only for most players. No new buying was allowed, only selling or closing out existing contracts. Margin requirements soared, making it nearly impossible for leveraged investors to hold their ground. The Hunt brothers, trapped in a market where they could no longer buy, faced mounting margin calls as the price began to slip. The pressure reached its breaking point on March 27, 1980, a day now known as Silver Thursday. As the Hunts failed to meet a $100 million margin call, silver collapsed by more than 50% in a single day. What had been a paper fortune evaporated, leaving the brothers deep in debt. The exchanges, backed by the banks, had changed the rules mid-crisis, demonstrating the power of institutional intervention to decide who wins and who loses when the stakes run high. For over a century, the London Silver Fix set the global reference price for silver with a daily phone call among a handful of powerful banks. By noon each day, traders from Deutsche Bank, HSBC, and Scotiabank would gather on the line, deciding the benchmark that shaped billions in contracts worldwide. In May 2014, this closed-door process came under fire when Deutsche Bank agreed to settle a U.S. civil lawsuit, admitting to manipulating the silver fix since at least 2004. The settlement unlocked a trove of internal chat logs and emails, revealing the mechanics of collusion in stark detail. Unsealed chat transcripts show traders openly discussing how to move prices around the fix. Messages that said, "Let's go smash it," and banging the close were not code, they were instructions. Traders shared confidential order books and coordinated trades to profit from price swings they engineered. The noon fix became a target, with teams timing large sell or buy orders to push the price in their favor, just as the benchmark was set. Plaintiffs' experts later estimated these coordinated actions delivered tens of millions in unjust gains to the banks involved. Deutsche Bank paid millions to settle but admitted no criminal wrongdoing. The fallout was immediate. In August 2014, after 117 years, the London silver fix was scrapped and replaced by an electronic auction. Yet even as the old system ended, questions lingered about whether manipulation had truly been rooted out or simply moved into new digital forms. In September 2020, JPMorgan Chase agreed to pay $920 million to settle charges brought by the Department of Justice and the Commodity Futures Trading Commission. The settlement described a pattern that lasted for years. From 2008 to 2016, traders on JPMorgan's precious metals desk placed thousands of fake buy and sell orders, a practice called spoofing, on COMEX and the New York Mercantile Exchange silver futures. These orders were never intended to be filled. They were designed to create false impressions of demand or supply, nudging prices in directions that favored the bank's real positions. The Commodity Futures Trading Commission found this manipulation occurred on an almost daily basis, involving coordinated sequences by multiple traders. 2 senior traders faced racketeering charges, and the enforcement order described the desk as operating a criminal enterprise within one of the world's largest banks. While the official record stops short of confirming the size of JPMorgan's physical silver holdings, outside analysts estimate the bank accumulated between 600 million and 800 million ounces during the same period. Public warehouse data show JPMorgan as a major operator of COMEX vaults, but regulators have not verified how much of that silver belongs to the bank itself. What is clear is that the manipulation was systematic, not isolated, and that it targeted the very structure of the futures market. Behind these trading tactics stood a broader motive. Since the collapse of Bretton Woods and President Nixon's closure of the gold window on August 15, 1971, policymakers have watched precious metals as barometers of confidence in the dollar. Federal Reserve transcripts from the 1970s and the 1980s reveal concern that runaway gold or silver prices could undermine faith in paper currency. While gold drew the most attention, silver's price was also managed through sales from government stockpiles and changes in coinage. The goal was stability, a dollar unchallenged by spikes in metals markets. But as enforcement actions have shown, banks found new tools in the electronic era, and the old motive to control volatility remains embedded in the system. Silver's role in the global economy is now colliding with limits that no amount of trading tactics can disguise. In 2024, the Silver Institute reported a market deficit of 237 million ounces, the largest shortfall ever recorded. For the third year running, industrial demand, led by solar panels, electric vehicles, and advanced electronics, is consuming more than half of all newly mined silver. This relentless pull is draining above-ground stocks at a pace that alarms even seasoned market watchers. CME warehouse data shows registered silver inventories sliding from a peak of 350 million ounces to just 274 million in less than 2 years. The drawdown is not confined to institutional vaults. Retail investors, galvanized by online communities like Wall Street Silver, have removed an estimated 110 million ounces from the market in 2023 and 2024 alone. With more than 240,000 members, this movement channels thousands of small buyers into a coordinated drain on physical supply, one coin, one bar at a time. Yet the paper market for silver remains staggeringly large. Analysts estimate that for every real ounce in the system, there are up to 500 paper claims, meaning futures, forwards, and unallocated accounts stacked on top of each other. If just 2% of those paper holders demanded actual delivery, the available inventory would evaporate almost overnight. In that scenario, analysts project silver prices could leap to $50, $75, or even $100 per ounce, inflicting up to $300 billion in losses on banks and clearinghouses exposed to short positions. The system, built on the assumption that few will ever call its bluff, now faces a stress test rooted in physical limits, not just financial engineering. Today, more silver trades as paper claims than physical supply exists, by a factor of 500 to 1. As industrial demand outpaces supply and inventories vanish, the old playbook no longer holds. The next move will not be made in boardrooms. It will be made by millions demanding the real thing. What happens then?